If you are a scalper, then you definitely must try out this scalping strategy. No indicators, no lag, just pure price action. We'll look for signals on the 1-minute time frame, using only price action and some basic smart money concepts like liquidity, supply and demand zones, and breaks of structure. The first setup focuses on a specific pattern, an institutional candle, followed by at least 8 inside bars, ideally 10 small candles, forming a tight channel. The trade is triggered when the price breaks out of this channel range. The institutional bar is the setup candle, a larger price bar that sets the initial range. Inside bars are the following smaller bars that form within the high and low of the institutional bar. When you see 8 or more inside bars, it shows the market is consolidating. I use this indicator to find inside bars. Now, this setup creates a channel on your chart. The top of the channel is the institutional bar's high, and the bottom is its low. The inside bars stay within this range, making the market look calm for a bit. The key is to wait for a breakout from this channel. This shows increasing momentum that could lead to a decent scalping move. For a buy trade, you'd enter when the price breaks above the channel stop. For a sell trade, you'd enter when it breaks below the bottom. The scalping plan here is that after this tight consolidation, the market is ready to make a bigger move. Now, this scalping approach only works in combination with support and resistance levels, or supply and demand levels. These areas help you find good spots to enter trades. When the price breaks out of the channel, near a key support or demand level, it's a stronger signal. This means you have 2 reasons to take the trade: the breakout and the level itself. When trading this setup, you also pay attention to the overall market context. Is the market in a broader uptrend or downtrend? This can help you decide which breakout direction is more likely to succeed. For exits, you can use minor levels. You look for small areas where the price has paused or reversed before. These can be good spots to take profits. This scalping setup is a classic example of trend continuation, showing how markets move in cycles of contraction and expansion. Big market players use cycles to build positions and profit from market moves. The ideal signal looks like this: a strong upward move, followed by a period of contraction, the institutional candle and the inside bars, ideally at a demand level, and then a breakout continuing the upward trend. This is how smart money operates in the market. The initial upward move, the institutional candle, is driven by big players. They buy steadily, pushing the price up. But they can't buy forever without causing the price to spike too quickly. So they pause, creating the contraction phase we see on the chart. During this contraction, the institutional candle sets the range, and the following inside bars show decreasing volatility. This is not random. Smart money is using this time to continue building their position without alerting other traders. The longer the contraction lasts, the more tension builds up. This tension is what fuels the eventual breakout. That's why I want at least 8 inside bars, preferably over 10. The contraction phase also serves another purpose for smart money. It creates a zone where other traders place their orders. Breakout traders put buy orders above the range, thinking they'll catch the move when it starts. Short-term traders might place sell orders, betting on a reversal. Smart money sees all these orders as potential fuel for the next move. When they're ready, they push the price up, triggering these orders. The breakout traders' buy orders add to the upward momentum. The short sellers' stop losses get hit, forcing them to buy and pushing the price even higher. This is the expansion phase. This is when we enter. The built-up tension is released and the price moves quickly. Ideally, the candles after the breakout are larger, showing increased volatility. This is the market expanding after the contraction. For us, scalpers, this pattern offers several potential entry points. You could buy the breakout when price closes above the institutional bar's high, or you could wait for a slight pullback after the breakout, which often happens as some traders take quick profits. The stop loss for this trade could go below the low of the contraction phase. If price falls below this level, it might mean the move has failed. As for targets, look at the size of the move before the contraction. Breakouts often move about the same distance as the prior trend wave. So to find a sell scalping signal on the 1-minute chart, you look for these elements. First, identify a strong downtrend on the chart. You want to see a series of lower highs and lower lows, confirming the bearish sentiment. Next, find the institutional candle, followed by 8 or more inside bars, creating a tight trading range. This consolidation is basically a pause in the downtrend, where buyers and sellers are temporarily in balance. Pay close attention to how price behaves at the bottom of this range. If it struggles to make new lows, or repeatedly tests and fails at a lower boundary, this could be a sign of temporary strength. But remember, we are looking for a continuation of the downtrend, not a reversal. A short signal would trigger if price breaks down below the low of the institutional candle. This breakdown should come with increased volume and larger red candles. For confirmation, you can wait for a small pullback. You're essentially looking for a weak attempt at an upward move that fails to gain traction. This chart shows a classic buy signal in an uptrend, with price reacting at a demand zone. First, we see a clear uptrend, marked by higher highs and higher lows. The uptrend sets the stage for our buy signal, as it's often best to trade in the direction of the main trend. The support zone, which can also be found on a higher time frame, is very important here. It was a previous resistance level that price broke through earlier in the uptrend. Once price breaks above resistance, that level often becomes new support. Notice how price reacts at the support level. We have our institutional candle, followed by consecutive inside bars, showing a contraction in volatility. The buy signal comes when we see a bullish candle forming above this contraction. Considering all these factors, it means buyers were stepping in strongly at support during an overall uptrend. Buyers took control, preventing prices from falling lower. A buy scalping signal must be strengthened by several factors. First, it must be in line with the overall uptrend. It should appear at a clear support level or demand area. And the institutional candle must have many consecutive inside bars. This scalping approach aligns with the principle that it's usually best to trade with the trend. In an uptrend, we look for opportunities to buy on pullbacks or corrections, and a demand area provides exactly that kind of opportunity. Now, not all breakouts are real. Sometimes the price might make a false move outside the channel and then quickly come back in. This is called a false breakout, and often happens with a pin bar, a candle with a wick outside the channel. This is the second variation of this scalping approach. When a pin bar happens, it's actually a good chance to trade in the opposite direction. So this chart shows a false breakout to the downside. The price made a quick move below the channel, but then came right back in. This is a signal to buy when the price retraces inside the channel. You see, false breakouts are often liquidity sweeps in disguise. Big players use false breakouts to trap traders and create liquidity. The institutional bar, followed by the inside bars, create a tight range. This range acts like a magnet for orders. Traders place buy orders above and sell orders below, thinking they'll catch the breakout. But smart money sees these orders as liquidity pools. When price breaks out of the range, oftentimes against the prevailing trend, it's often not a real move, it's a trick. Big players push the price just far enough to trigger these orders. They're not trying to start a new trend, they're hunting for liquidity. In this particular case, we see an upward false breakout. The price moves above the range, but it doesn't stay there. This quick move up is the liquidity sweep. Observe the institutional candle, the inside bars, and then the pin bar, completing the pattern. This inducement is designed to do two things. First, it triggers buy orders from breakout traders. They see the price rise and think a big move up is starting. Second, it hits the stop losses of traders who sold near the top of the range. They thought price would go down, but now their stops are getting hit. All these actions create a pool of liquidity, and that's exactly what smart money wants. They use this liquidity to enter short positions at good prices. The key is waiting to see what happens next. Price doesn't keep rising. Instead, it snaps back into the range. This is the immediate retrace we see on the chart. It's a clear sign that the breakout was false. This retrace is smart money selling. They are using all that liquidity from the sweep to enter their positions. Now they have the fuel they need to push price lower. For us scalpers, this false breakout is a selling opportunity. When we see price retrace back into the channel after that quick rise, it's our signal to sell. We're essentially trading with smart money, taking advantage of all those traders who got tricked by the false breakout. But why does this work? It's all about order flow. Markets need a balance of buyers and sellers to move. If everyone's buying, who are they buying from? If everyone's selling, who are they selling to? Smart money uses these sweeps to create that balance. Think of it like this. If smart money wants to buy a lot of orders, they need someone to sell to them. But if the market looks bullish, not many people want to sell. So they create a scenario that encourages selling. That's our false breakout. Once they have these sellers, they can buy. This concept of liquidity is crucial in understanding market moves. Price doesn't just move up or down randomly. It moves to where there are orders. These orders are liquidity, and smart money is always looking for liquidity. In this scalping strategy, we are not just looking at price. We are looking at the story behind the price. We are trying to spot these liquidity sweeps. When we see a tight range form, we get ready. We know smart money might try to sweep that range. And remember our first approach. Not every breakout is false. Sometimes price really does start a new trend. That's why we wait for the retrace. We need confirmation that the breakout was indeed a sweep, not a real move. This chart shows a buy signal in an uptrend, with price reacting at a key support level. We first see a clear uptrend, marked by higher highs and higher lows. The uptrend sets the stage for a buy signal, as we aim to trade in the direction of the order flow. The support level is crucial here. It was a previous resistance level that price broke through earlier in the uptrend. Then we see price pull back to test this new support level. Notice how price reacts at the level. We see an institutional candle and a series of small bars forming just above support. These are inside bars, showing a contraction in volatility. The buy signal comes when we see a wick outside the channel, followed by an immediate retrace. This is a classic sign of a liquidity sweep. Price briefly drops below the support level, triggering stop losses of weak longs. Smart money quickly buys up these orders at a discount, and price immediately retraces back into the trading range. This price action suggests strong buying pressure at support. It's a sign that big players are possibly accumulating positions, setting up for the next move higher. The next bar is our entry signal. This bar closes firmly inside the trading range, confirming that a drop below support was just a trap for weak hands. Any buy signal after an institutional candle and a pin bar must be strengthened by several factors. First, it must be in line with the overall order flow. Then it must be at a clear support level with several touches, or at an unmitigated demand area. And the quick rejection of lower prices must confirm the buying pressure. Let's look at another case, a short signal. First, we see a clear downtrend, marked by lower highs and lower lows. So this downtrend sets the stage for our short signal. And here, notice this supply zone, which is unmitigated, has not been touched before. We see price rally up to test this area. This rally is normal and healthy in a downtrend. Notice how price reacts at the supply zone. We have an institutional candle, then a series of small bars. The short signal comes when we see a wick outside the channel and an immediate retrace. This is the liquidity sweep we need. Price briefly spikes above the resistance level, triggering stop losses of weak shorts. Smart money quickly sells into this rally, trapping late buyers, and price immediately retraces back into the trading range. This price action suggests strong selling pressure at the supply zone. It's a sign that big players are setting up for the next move lower. As the next candle closes firmly inside the trading range, it confirms that the spike above the channel was just a trap for weak hands. Another signal, this short setup is valid because it's strengthened by multiple factors. It's in line with the overall downtrend. It's at a clear resistance level with multiple touches. And the quick rejection of higher prices shows strong selling pressure. For the entry, you could short as the liquidity sweep bar closes. The stop loss could go just above the wick of the previous bar. Now, what if you don't have an institutional candle to trade? Well, another variation of this scalping method is when you first spot a pin bar and then an inside bar. So first you have a pin bar with a long tail and a small body rejecting a level. For a real pin bar, the tail must be at least 50% of the bar's total range. The longer the tail or the wick, the stronger the pin bar signal. Candles with long wicks are great for scalping because they help you spot possible market reversals. When pin bars form, it often means the market might move in the opposite direction, at least for a short while. The opportunity comes when the next candle's range fits inside the pin bar's range, so the high and low of the second candle are completely within the first candle's range. This is the pin bar inside bar combo, so you look for a candle with a long wick at a key support or resistance level. You wait for an inside bar to form right after the pin bar, and you enter the trade when the price breaks out of the inside bar in the direction of the pin bar. Here's a bullish setup. The pin bar forms at a demand zone or support. This long lower wick shows strong buying pressure. It's like buyers are rushing in to grab a good deal when the price dips too low. The inside bar that follows is a pause. Buyers and sellers are sizing each other up, waiting to see who will make the next move. When price breaks above the pin bar's high, it implies demand has won out. Buyers are pushing the price up, and some sellers might be closing their losing trades, adding more upward pressure. For a bearish setup, the pin bar forms at a supply zone or resistance level. That long upper wick shows strong selling pressure. Sellers stepped in when the price got too high. The inside bar is a small pause. The market is stalling after that reaction at resistance. A break below the pin bar shows supply has taken control. Remember, the location of the pin bar is crucial. It should be at a level where the market has turned before, or at an unmitigated supply or demand. And the inside bar adds more strength to the pin bar signal. It shows that the market is confirming the potential reversal that the pin bar hinted at. For a bullish setup, you enter a buy order just above the high of the pin bar. You place your stop loss just below the low of the wick, and you set your target at the next resistance level. The same for a bearish setup. Enter a sell order just below the low of the pin bar. You place your stop loss just above the high of the wick, and you take profit at the next support level. And here are some extra tips to make this scalping setup even better. First one is order flow alignment. This one is obvious. You try to trade in the direction of the bigger trend, so check higher time frames to confirm the overall trend and key levels. You also look for other price action signals that support your trade. This could be a trend line break, a chart pattern, or confluence with a Fibonacci level. And of course, volume. High volume on the pin bar compared to the previous candles will make the signal much stronger. In this specific instance, we see an uptrend. The price moves up in a series of higher highs and higher lows, so buyers are in control. We look for long trades only. Then the price hits a support level, a key area where buyers have stepped in before. At this level, we get a pin bar. The long lower wick tail shows that sellers tried to push the price down, but buyers had more power. This quick reversal trapped sellers who thought the price would keep falling. Then we see the inside bar. It fits entirely inside the range of the pin bar. To trade this, you'd buy when the price breaks above the high of the pin bar. This break shows that buyers are taking control again. Your stop loss would go below the low of the wick. This is the danger point. If price falls below here, the setup has failed. As for target, look for the next resistance or supply zones above. Just remember that this setup works best in trends. And watch how price acts after the breakout. A momentum move up right away after the breakout is what you want to see. If it hangs around near the breakout point, be cautious. it might not have the momentum we hoped for. Here's a short signal. First, we'd see a downtrend. The price moves in a series of lower highs and lower lows. The price would then hit a resistance level. Sellers have stepped in before, so it might be a good area to monitor. At this resistance, we'd get a pin bar, this time with long upper wick. This quick reversal traps buyers who thought the price would keep rising. Right after the pin bar, we'd see the inside bar. This combo of pin bar at resistance, followed by an inside bar, is a strong sell signal. So we enter short when the price breaks below the low of the pin bar. This scalping method gives you a structured way to trade. It combines the power of pin bars to show potential reversals with the confirmation of inside bars, and the breakout entry helps you avoid many false signals. By waiting for both patterns, you're being patient and selective, which is mandatory when scalping. You're waiting for the market to show its hand before you commit your money. Now, if you want to learn other scalping methods, go ahead and watch one of these videos.